Assalamu alaikum everyone. Welcome back to Ethical Finance Talks. If you've ever wondered how you can invest in a business without taking on all the risk or manage a project without providing all the funds, today's episode is just for you. I'm your finance guru and we are about to dive into the exciting world of Musharakah and Mudarabah. Now, there's two simple yet powerful ways to finance business ventures ethically. Ready to rethink the way we invest? Let's get into it. We've already talked about what Musharakah and Mudarabah are in previous videos. Today, we will see how you can use these concepts in real life. Now, traditionally, these two methods were used to start a business from scratch with all partners involved from beginning to end. But can you use them for an ongoing business where partners can join or leave without disrupting things? Absolutely. Let's see how. First, let's recap the key principles of Musharakah and Mudarabah. Now, these principles are crucial for maintaining fairness in business transactions. Number one, active participation. Musharakah and Mudarabah mean being part of the business, not just giving money. Two, sharing losses. Investors must share any loss the business incurs proportional to their investment. 3. Flexible profits. Profit sharing can be agreed upon, even if it's different from the investment ratios. 4. Loss distribution. Any losses must be shared according to the investment ratios. Now, how can these principles be applied in real-world scenarios? Let's start with project financing. Imagine you want to build an apartment complex. If one person funds the entire project, they provide the money and you manage the project. Now, this is called Mudarabah. If both of you invest money, you can use Musharakah. Now, both of you invest money, it means you can use Musharakah, sharing both the management and profits. What if a partner wants to leave the partnership? No problem at all. The remaining partners can buy the leaving partner's share at an agreed price. Now, this way, the person leaving gets their money back, possibly with profits, and the project continues smoothly. Financial institutions often prefer not to remain long-term partners in a project. They might sell their share to other partners or new investors. Now, if selling at once is hard, they can sell smaller units gradually. Now, this will help them get their money back without affecting the project's stability. Now, let's talk about how to attract big investment for large projects using Musharakah. This is done by issuing what we call Musharakah certificates. Think of these certificates as pieces of ownership in the project. When you buy a certificate, you own a small part of the project, like owning a small part of a big building. These certificates can be traded or sold in the market once the project has bought substantial things like land, buildings, or machinery. However, these certificates cannot be traded if all the project assets are still in cash or receivables, because this would essentially be like trading money for money, which is not allowed under the Sharia law. For example, let's say a project raises $100 million through Musharakah certificates. Now, these certificates represent your share in the project's assets, like land, buildings, or equipment. If you buy a certificate, you own a part of these assets. You can trade or sell these certificates in the market just like stocks. But if all the project assets are still in cash or are debts owed to the project, trading the certificates would then be like trading money for money, which isn't allowed in Islamic finance because it could involve interest or what we call riba. What if a project's assets are a mix of cash and physical things like machinery? Some scholars say you can trade these certificates as long as the physical assets make up the majority. For example, if a project has 60% in cash and receivables and 40% in machinery and fixtures, you can sell these certificates for more than just the cash value. And this is because the certificate represents a share in the tangible assets like machinery, which have real value beyond the cash. Now, let's consider a practical example. Suppose you are a part of a group investing in a tech startup. Using Musharakah, everyone pools their resources to fund the development of a new gadget. As the product hits the market and sales grow, profits are shared according to each person's investment. Now, this method not only spreads the risk, but also makes the investment accessible to those who may not have large amounts of capital. Musharakah and Mudarabah can also be used for financing a single transaction. For instance, if you are an importer and need funds for one shipment, you can approach a financier. If the financier provides all the funds without requiring you to put up any of your own money, you use Mudarabah. If the financier asks you to contribute some of your own money to the deal, you use Musharakah or a mix of both. Once the goods are sold, you share the proceeds based on your agreement. Now, this way, you don't need a long-term commitment, just support for the single transaction. Now, similarly, for exporters as well, Musharakah can be used. Imagine you get an order from abroad and needs funds to fulfill it. A financier can provide the funds and you share the profits from the sales. This method is straightforward and ensures both parties benefit. The financier protects themselves by setting conditions to avoid losses due to possibly negligence. Now, what about existing businesses, ongoing businesses? Musharakah works here too as well. First, you figure out the current value of your business, then you and the financier agree on how much each of you will invest and how to share the profits. For example, let's say your business is valued at 30 units. A financier comes in and adds another 20 units, bringing the total to 50 units. You both agree that the financier will get 40% of the profit because they contributed 40% of the total investment. You continue running the business with this new arrangement. At the end of the agreed period, you check the value of the business again, share the profits as planned, and decide if any changes are needed to your investment. In some cases, it might be hard to evaluate all assets due to depreciation and other factors. One way to handle this is to agree that the financier gets a share of the gross profits instead of net profits. Now, this means indirect costs like staff salaries and machinery depreciation are borne by the business owner, not the financier. This simplifies the accounting and avoids disputes. To wrap up, Musharakah and Mudarabah are flexible, ethical, and practical methods for modern business financing. They allow for shared investment, risk distribution, and adherence to Islamic financial principles. These methods can be adapted to various sectors from real estate to tech startups, making them incredibly versatile. What do you think about these methods? Could they be the key to more ethical and collaborative business practices today? Share your thoughts in the comments below. And if you find this video helpful, please give it a thumbs up, share it with your friends, and don't forget to subscribe for more insight into ethical finance investing. Thanks for watching Ethical Finance Talks and see you next time. Assalamu alaikum wa rahmatullahi wa barakatuh.